Now, the global chip industry is headed towards a glut, some economists think, as the lockdowns and the pandemics work their way through. And now we're seeing more and more companies say they have too many chips, so they're trying to cut back on production to prevent this glut. Well, joining me now is economic commentator Justin Urquhart Stewart to talk about this very interesting space. Justin, thank you so much for joining us. Chip makers have had a rocky ride of late since the pandemic, haven't they? They've gone through peak and trough. Where are we at now?
It is quite astonishing when you look what's happened over the past 2 years, from seeing a global shortage, then finding ourselves with a glut. You really couldn't make it up. And of course, there's still some very big risks out there, because look at the producers; they're still very constrained to a relatively small numbers of areas to come from, and of course, still very dependent upon China and also dependent upon Taiwan, particularly. And so it's going to be very difficult to try and pick out individual winners on this. What you are now seeing, of course, is, and it'll be interesting to see how some of the retail sales are going to be in terms of cars and other equipment, to see how the demand is now picking up, and of course supply is now coming through. Because remember, it was that big supply chain issue that really broke up the market so drastically. So what I think you're going to be finding now is, having pressed the accelerator 18 months ago, now foot's off the accelerator, now on the brakes. They're trying to hold up production because they're going to find themselves with far too much of a glut. And the industry's got to learn to try and actually manage itself far more effectively. And for investors, this makes it very difficult indeed. Trying to pick winners in moments like this, I think, is actually a bit of a mud's game. So I think you're going to have to look quite carefully at the sector rather than necessarily at the individual companies, because I'm not too sure necessarily the companies know themselves quite what's going to be happening.
Now, we're seeing signs that the sector is trying to correct itself. We've got Intel coming out saying that its sales outlook was behind Wall Street estimates. It is trying to claw back the production and the output of chips. South Korea's Samsung Electronics, same story there, indicating it has no plan to cut investment in chips this year. However, it has said that it is aware of the weakening global economy and that the industry is facing its worst downturn in more than a decade. Do you think that these chip makers, the sector as a whole, is able to clamp down on demand fast enough?
I think it's if they haven't learned from what's happened in the past 2 years, they haven't been paying attention. They really do need to make sure they have to adjust very quickly indeed. There is going to be a slowdown, whilst China will be opening up. Actually, it's going to be, I believe, at a much slower level. Europe's going to find itself, I still think, with actually some significant problems this year. Inflation hasn't gone away. It'll be reducing, but I think inflationary pressures in Europe will be higher than, say, America. And so I think you're going to find life slower there as well. So if I was in the position now of actually ordering the chips for the next year, I'd be making sure that actually I'd be bring my production back, if I possibly could, not find myself with too much surplus, because otherwise I'll find myself in a position having to lay factory time off. And frankly, that's just going to mean I'll be losing money.
Given all this, everything's changed in the sector. I mean, if you buy a fridge, microwave, all those things have chips as well. Do you think traders should actually look at diversifying in terms of parts of the sector? So, for example, NVIDIA, should traders be looking to buy more into gaming chips, for example, rather than autos? Or certainly, should we be looking at more to do with chips, to do with white goods, as more and more people spend more time at home?
Well, I think that's fascinating, because if you can actually start dividing up the companies into what they're actually providing, and you can do that with the likes of NVIDIA, and then take a view, yes, there's going to be more gaming going on, there's more expansion there, you can start making, I think, a better investment decision based on anticipated demand. So divided up between white goods, manufacturing, gaming, and there'll be other subsectors to that. Equally, of course, there's another way of playing it. There is, of course, an ETF which actually looks at semiconductors. And you can actually look at that on the basis that sometimes it's a bit like trying to pick individual pharmaceutical companies. Whichever one's got the magic drug, it'll be the one next door that's actually going to win. So if you don't think you can pick individual ones, go for the ETF overall and follow the sector through. But I think actually, for the clever investor now, if you think gaming is going to be there, you can actually start picking some of those out. I think that's going to be a much more interesting play coming through. And I think that some of the cars, now you're getting more delivery, beginning to start trying to ramp up delivery times. question is, therefore, though, is there going to be the demand for those cars at the end of it? I think that entire industry is going to find itself in a great difficulty at the moment as it moves over towards more electric cars. Is there going to be demand there? And can people be affording them? So I think with a slowdown, I'd be rather circumspect about some of the manufacturing areas, and maybe things like games, I think, would be much more interesting play.
For those traders out there looking for a longer term play, would you say just come out of this sector for now and then perhaps jump in when things look a bit more stable?
Well, I think that's quite interesting for that, because that's where your ETF would actually be quite helpful. It's the VanEck ETF. If you're not sure about a sector, stay away from it for the time being, see how it's moving, and get an idea of the lines it's moving between, its highs and lows. And when it starts breaking out of those, you can get, particularly on the way down, then you might find yourself in a position where you'd actually then start buying it on the basis of value, whilst you don't necessarily have to be an expert in the individual manufacturer themselves. So I think that's quite a good way of trying to play it. If you're not an experienced investor and you don't know enough information on the individual companies, and quite often it's quite difficult to get all the information on those companies, because quite often you find when the comments coming from the companies themselves, you'll find that quite often they don't know either, which is really rather worrying. So take a more sensible way of this, take a slightly broader view, use the ETF to actually spread your risks, don't dive in yet, just wait for actually a bit more weakness on, and then I think you'll find a good opportunity to go back in.
Thanks very much, Justin Urquhart Stewart there, economic commentator, with his views on how to hedge the chip sector and the potential glut that is incoming.